Hey everybody, it's Pete. Good morning. Welcome to today's episode of Stock Trading Pro. In today's Stock Market Live, we're going to talk about the Fed, and the didn't really say anything new other than we're going to raise rates, but everybody knew that. It spooked the market, panicked the market, actually, I would say, in a much bigger way. Stock market did not react positively. We had a big list of the best stocks to buy now that we created yesterday morning. Hopefully you watched that video. And the bottom line is we took the trades, the market rolled over, and you act like a professional, and either you book profits quicker, you get out, or you look to short sell, which we're going to talk about short selling today as well, or you can buy inverse ETFs, which we talk about a lot. And I'm super happy to see that a lot of people, both here on YouTube as well as in our community, are embracing the other side of the market if stocks go down. I will tell you this, and this is, if you don't know, actually today is April 6th. 22 years ago on April 17th is when I actually started trading. So we're going to actually have some kind of celebration here. I started after the dot-com boom, and we did nothing but short sell for the first 2.5 years that I traded. So if you could imagine, April of 2000 until I believe March of 2003, when the market finally bottomed out and we started to rally. Here's the thing I want to get you excited about. If you're a regular viewer of the channel, you know that we spend a lot of time both talking about ideas, which are the best stocks to buy now. We talk about the stock market every day, but we also talk about trading strategy. If you're open and willing to embrace, if you're willing to embrace looking at the other side of the market, which means short selling or making money as stocks go down, got a pretty good feeling we're going to have some opportunity on both sides. And I don't know if John Bates is on the call right now with us. Let me see. I don't see him right now. But John Bates, hey, Juan Garcia, good morning, pal. How's it going? John has started to trade the inverse ETFs a little bit more in our boot camp, and that's a big question that a lot of people have. Now, here's the big thing I want to get across. We're going to talk about hedging, even if it's not a straight up short sale, to protect the gains on some of the stocks that you bought, or just straight up looking to be a buyer of inverse ETFs or a buyer of puts if the market goes down. So we're going to cover that today. We're going to take a look at sector rotation, give you a quick look at what we're about to cover and how that's going to unfold. And then I'm going to talk to you about some of the good ideas that I'm looking at today, one on the long side, one on the short side. But first, we're going to actually get into what exactly short selling is. So stick around. We'll be back in just 1 sec. We got a lot to cover today. Okay, so thank you so much for joining me here today, everybody. I really appreciate it. We're actually going to start out with short selling stocks. I want to say hello to Simon. Hey, Simon. How's it going over in the UK? Nice to see you here today. And, of course, my buddy Brian O'Shea. Absolutely. David LeBate. Good morning. I have to say hello to our peeps. Very happy and grateful that you've been a part of our community. And John, good morning, John, as well. Good morning. Good morning. Yeah, it's been April. I know exactly. I can tell you why I know the date. I don't want to bore everybody with the details of it, but if you don't know, my family owned a deli and a pizzeria on Long Island in the 1980s. And obviously worked there with my brother, my mom. If you've been around Italian people working together all day, there was a lot of fireworks, to put it mildly. Couldn't take it anymore. Ended up becoming a full-time trader. I've been trading since 94. I was trading commodities first, but I ended up trading full-time in April 17th of 2000, which was a really unique time because that was when the dot-com boom was ending, and a lot of people lost absolute fortunes. I witnessed when I first started trading. Now think about it, everybody being super excited to be an active day trader at that time. Day trading was everywhere, super popular. People with $1 million accounts, $1 million trading accounts, whose entire strategy was the market always goes up, just buy more if it moves against you, and 2 days from now the stock will be much higher. And multi-million-dollar accounts blown up in 6 months because they didn't understand tape reading, they didn't understand order flow, but more importantly, did not understand how to change their bias if you understand tape reading. And that's a big part of what we talk about. So when we talk about sector rotation here, this is essentially what we're watching from one day to the next, but we're also watching it across multiple time frames. So the day, the month, and the week. And very important to pay attention to, how should you adjust your expectations for your trades based on the market changing, the order flow changing? Do you buy stocks? Do you be in cash? Or do you actually short sell stocks? Or you really want to raise your game? Do you do both and hedge your longs with short positions? So there's three different ways you can have short positions to hedge. You can just outright short sell other stocks. And I just want to walk you through how to do that. And we're going to actually take a look at the spreadsheet here. So if we take a look at from where we started on Monday, and you can see the month was pretty amazing. We started to roll over into heading into Tuesday, still pretty good, but saw some cracks here. So industrials and financials, that's actually a big part of the Dow. And then heading into today, heading into Wednesday, you can see the picture has changed dramatically over the last 5 days. Should not shock us that consumer defensive stocks actually rally to the top of the list. You're talking about like Pepsi, Johnson & Johnson, and that kind of thing. And utilities, believe it or not. Now, those aren't usually ones that I trade on a daily basis, utilities, because they just don't have enough volatility for me. So when you're picking the stocks to trade, that's actually a really big question that we get from new members into the boot camp and a big part of what we do. I understand when new traders or traders without a trading plan want to trade stocks that are a little bit less volatile because you feel like you're keeping your risk lower by trading stocks or buying stocks that don't move that fast. And I did that when I first started trading. But the problem is you're also limiting your upside where you don't have enough volatility to actually make money because stocks will just kind of dance around. So if you want a little bit of a trading suggestion that I teach to everybody is there's this balance between volatility and liquidity that every trader needs to go through, where liquidity is there's enough institutional smart money attention on the stocks every day so that you can reasonably get in and out where you want to. And the spreads are a little bit tighter because there's a lot of shares to buy and sell at every price action. And it happens on a regular daily basis, whether you're swing trading or day trading. But then the second part of that is the volatility part, which is having the opportunity to make money when you buy stocks. So when you head into the stock market, you're like, all right, I know whichever stocks I'm going to look at, that's going to be my personal ATM, because on a daily basis, I might have 5 stocks that I watch. Maybe 2 of them on a daily or weekly basis are in play. That's a big part of it. So I'm actually, what I'm actually going to do? I'm going to pull up the software that we use, Finviz. If you haven't been to finviz.com, you could actually post that link. It's finviz.com. You could actually, I don't know if you could actually see it. Let me just bring that down so you could actually see it in the camera there. But what I want to walk you through is some of the setups that are my template. Okay. And this is really the stuff you want to look at right here. And again, when I pull this kind of stuff up on the screen, you definitely want to take a screenshot of it, hit the button on your keyboard, and then use this as kind of a template for you to start to look for ideas. So I'm just going to walk you through really quickly how to come up with some ideas. But here's the big thing. You need filters. And excuse me, you're looking at a filter. A lot of people say the filter is the criteria. And that's true. Before you look at anything, it needs to meet the strict criteria before you're like, all right, those are the stocks I would consider buying, or the stocks I would consider short selling, which is actually what we're going to talk about in a second. So take a screenshot of this. I'm going to walk through the basic criteria. So you can see here, I'm only looking at stocks. I don't look at ETFs in this particular breakdown. Over here, price, I generally don't go below $10, but I tend to stay above 15. Average true range, and if I hover over that, you can see what the breakdown of that is. It's basically the average of the low to the high, and you can see it's average. Most software defaults to 14 days. So basically that means it moves on average from the low to the high at least $1.50. So I'll pull up a stock here just to give you an example of what that means. So let's just say, for argument's sake, we go into JP Morgan, which is a pretty popular stock. You pull it up and you go down over here and you'll see ATR. JP Morgan's average true range is $3.95. So that means if we take a look at JP Morgan, on average over the last 14 days, from the low to the high, it averages $3.95. So that's the amount of opportunity if you happen to be day trading JP Morgan or looking at it over a 5-day period. You have a pretty good idea of what the opportunity is to make money, which will also give you an idea before you buy that stock, what is the risk as well. So how much does it move, and can you handle those kind of moves, and do you have the right share size when you choose to buy that stock to allow the stock to fluctuate? That's actually been a really big question that we've had in the boot camp with new people that just started this week. Is it doesn't matter if it's a $10 stock or a $1,000 stock, you should still only be risking the same dollar amount, but you need to adjust your share size to compensate for wider stop losses on stocks that are more volatile. So if we take a look here at JP Morgan, we said that it's $3.95. And if we pull that up, you can see on a daily basis how much JP Morgan moves, which you can see over here. That's how much it will move. But if we go to something like Tesla and take a look at Tesla and did the same exact thing for Tesla, Tesla's average true range is $48.66. So that means on average over the last 14 candles, it moves an average of 48.66. So that's a big difference. So I'm bringing this all the way back into learning how to hedge and what the Fed did yesterday, the announcement that they made. Plus we have the Fed minutes today, which, my gosh, if you're a day trader, you absolutely need to be on top of the Fed minutes, which come out at 2 p.m. Eastern time today. That's when they're scheduled to come out. That could be another market rattling news. But here's the thing. The Fed, when heading into January, they didn't do anything. January 2022, and the market sold off out of uncertainty about what they were going to do and when they were going to do it. The last Fed meeting, they actually did something, and the market reacted in such a way that it sprinted back to the upside right here. So this was Monday, Tuesday. This was the day that they announced that they were raising interest rates, and we spiked back to the upside. So now we have more uncertainty, and that uncertainty was exacerbated yesterday by this, okay? Keep people from the Fed, just spook the markets. Here's what they said. They didn't really say anything new. They mentioned inflation. They mentioned higher interest rates, and they mentioned that inflation needs to go down. Now, let me ask you a question. Is that any news? That's not news. It wasn't anything that they didn't say before, and anything that they've already said they're going to raise multiple times. They already said inflation's out of control. They already said that they were going to raise, but now they said definitively versus what they did last year where they said, it's coming soon, it's coming soon, it's coming soon. And they didn't do anything. So stocks continued to rally even right into the last week of 2021. But now into this year, they've now said, we are raising. We are not kidding. We are raising. And that spooked the markets again yesterday. So now the big thing to pay attention to, especially if you're on the day trading side of things, is the Fed minutes. If you're not familiar with the Fed minutes, it's basically them reiterating everything that they talked about at the last meeting. So how does this come all the way back to what we're talking about with sector rotation? And why did we just bring up the average true range, right? So we're talking about stocks and their volatility, and we're talking about stocks and breaking them down. So obviously we're heading into today. We talked about, is it time to buy stocks, or is it time to step aside? Is it time to panic if you don't have a plan? If you don't have a plan, download the Smart Money Footprints. That's in the description here. Now's the time to really be super stringent about the stocks that you're going to script. So we're actually going to look at two sides of the market right now, the best stocks to buy now and the best stocks to short sell now, which you could either take an outright position on the short side or simply take a smaller position on the short side and hedge against your long position. So I'll give you an example. And this is a trade that we have on right now. Okay. So let's say we have a trade on in Facebook, which we actually initiated around the 218 level, down right around here, somewhere around that area, right? So this pushed up and traded sideways. We mentioned this yesterday, and this is a big question that we get quite often, the difference between short covering rallies versus new buying. Short covering implies a big move to the downside. Short covering is a fast move off of those lows. We don't know it's short covering, but we know to be aware for short covering because of the fast move off the lows. So short covering, if you don't happen to understand what short selling means, you are betting that it's going down. So if you are betting that it's going down, you borrowed shares from your broker dealer or you bought puts expecting it to go down. So when you buy puts, you're looking for it to go down. But for you to get out of that position, you have to exit that short side. You have to get out of the short side. So if you sold it short, you have to buy it back. So that's what it means, short covering rally. Short covering means you're buying stock back, which is buying that causes a fast rally. So if we go over to Facebook, and quite honestly, the market, this here, rally, but then goes right back down. So that's how we know that was a short covering rally, because it went straight up. And again, that was a different situation with the Ukraine invasion, but fast move to the upside, but then went straight back down. So we know kind of It's not after the fact because you're putting the pieces together to know what you're looking for. Short covering goes straight up and down, and then you continue to look for more short sales because that just exited the short side of the market. That doesn't mean new buying came in yet. So the trick, the key, the secret that everybody wants is how to identify short covering rally versus new buying. Well, it really comes down to this. If the short sellers who bet that the market or that stock was going down are still there, they would come back in and start short selling again, and supply would get dumped back on the market, and you'd see another move down. This is what you're looking for, because FB Meta Platforms is a good example here, where you rally off the lows and then go sideways and stay there. That means that new bids are under the market and holding it, which is why we initiated that new swing trade, which you see over here. So this went up and then went sideways, which you can see this is actually where we initiated the long. So what does that have to do with everything we're doing right now? So we're actually long a position of Facebook. That's one of the swing trades from last week. I believe it was the last week in February. So how do you translate, I want to protect those profits with short selling ideas or just straight out short sell? That's where we go back into the scans and we take a look at FinViz. So now we have the criteria of stocks only, over 2 million average volume. And you can see that per day, average per day. Liquidity, volatility on the average true range, and this. So now if I'm looking for the best stocks to buy now, the minimum criteria, I'm going to put, I want it to be above the 50-period moving average. That's a big part of what I want to do, but I want it to be a little bit more stringent than that, but we're going to look at both sides. So right now, you can see here in the corner, there's 63 stocks that meet that minimum criteria. Now, here's the $1 million. That doesn't mean just go out and buy any one of these $63 stocks tomorrow. You need to determine, is there an entry setup right now that is closest to the optimal entry? So remember, we're filtering out for the order flow right now that these stocks are showing strength. So we would consider those to be the best stocks to buy now. But then we need to take it a step further and now look at the optimal entry. So that means, yes, that means that we need to go each stock and say, okay, which stocks right now, if you remember, we look at pushes and pauses, which stocks are pausing right now for at the very least 1 day, best case scenario, 2 to 3 days. That tells us now, and I went over this in a lot of detail with John Garcia on our coaching call the other night about identifying the optimal entry and how to buy at the right time. That's the big thing. Everybody wants to know the secret of what happens between entry and exit, which is where the money's made. The money is made in the stock market on the exit. The entries you could work, obviously, when you find the order flow, you read the tape, you could find it a good entry. It doesn't have to be perfect, especially because you could work the order. It's the exit, which is where the magic happens. And let me give you a little something you know, but I'm going to talk about it anyway. Losing exits, trades that don't make money, that you exit when you're supposed to, is what instantly moves you closer to profitability because you're keeping small losses reasonable while you're still hunting for those gains that follow through. So as much as everybody wants to know where to exit profitable trades at the best time, which is a big thing to learn and know and structure, you also need to, the upside only matters if you're taking care of the downside. So let's go back over to the screen here. We're going to talk again about, this is the stocks that meet that criteria. So we would filter this down, and now we would start to look for ideas that match the criteria that they're either breaking out or past the down move or in existing bullish order flow. So a lot of these stocks like BILI, I probably set alerts for this are probably like 32. I'd go over to the screen and dig a little bit deeper, and I'd probably say, okay, yeah, $32 would be the level. So then I'd go into my software and I'd be like, okay, it's interesting. It's showing relative strength. It's above the 50. And then I'd go and set an alert at 52. So I'd go in here, set an alert, and I'd set the price for crossing above 52. So I'd probably put it just above that level because I want to know when it gets through there. Don't call me until it gets there. So that's the first part of finding some of the ideas that you might like on the long side. But we're going to actually make this a little bit better. You see how it's just crossed above the 50? I want 10% above the 50, and that just knocked off a bunch of stocks. Now we're actually going to break it down a little further and say, are any of these stocks also above the 20? And that also took out some more stocks. So what we're doing now is we're filtering out thousands of stocks down to there's only 50 that I would even consider putting in my game plan to be one of the best stocks to buy now. But that's only the filtering criteria. Then we have other stuff of identifying the order flow. How long has the order flow been obvious? Reading the tape across multiple time frames, and then finding the optimal entry. These are the best stocks to buy now just from criteria, but they're not stock picks yet. So getting back to what the Fed said yesterday and scaring the market and the possibility of the tape changing, if you watched yesterday's video, we were very clear on reading the S&P 500 and what that needed to look like to determine whether or not the trade would hold up. And we actually spent a lot of time on the weekly chart, where we said the weekly chart after the last Fed announcement, this week went well bid with buying pressure, followed up by another week and followed up by another week. But we said very clearly last week, while it was well bid, higher highs and higher lows, it turned into what a lot of people know as a topping tail. So when we talk about topping tails, that's usually a momentum reversal strategy. Momentum then typically leads to order flow. So yesterday with the Fed announcement, it looks like the order flow right now is starting to reverse. And if you remember what we said, there was two scenarios that we built out for this entire week. And this is what is going to elevate you from an average trader to somebody who's in control of the outcome because you have the roadmap, you have the structure. Yesterday, we were very clear. We were looking to be aggressively buying stocks if we stayed above the opening price from Monday and if we went well bid on the weekly chart. If that did not happen and traded below the opening price and the daily chart went well offered, which meant lower highs and lower lows, that meant that the tape has changed and now how we look at stocks changed. That's all. My God, that's so much, right? No. Monday's opening price is the weekly chart red or green. Start there. Get rid of all the garbage on your charts that's making it so complicated for you to look at the stock market. Is the weekly chart red or green? That's the super high level 30,000 foot view of understanding how to read the tape. There's a whole bunch of other stuff that we talk about, but that's the number one thing. And again, the biggest frustration that we get from people that come into our community is they don't know when the story has changed and continue to blindly buy stocks, not acknowledging that the tape has changed, not understanding when the smart money says, nope, we're going that way. You're going north, we're going south, and you don't recognize the red car going the other direction. It's learning to make these distinctions that gives you the power over what's going on in the stock market instead of feeling like you're helpless. That's what makes all the difference in the world. It's not about predicting. It's not about forecasting. It's about paying attention. You just simply need to understand how to pay attention. So bringing this all the way back to what the Fed did yesterday with what they spoke about, with the Fed minutes coming out today, we now have tape reading insights to take a look at the market. So you can see here on the market yesterday, we reversed on the weekly chart, but the daily chart actually had a bearish engulfing candlestick. Bearish engulfing candlestick means the current candle that just completed took out the high and took out the low and closed below the open and below the previous day's low. So that is a bearish momentum reversal. It will become bearish order flow if the weekly chart actually does the same exact thing, but go lower highs and lower lows. So bringing this all the way back to those stock picks, the best stocks to buy now, and that screener right here. First of all, the rotation, you can see going into Wednesday, much weaker utilities, but there's a group of stocks down here that we could take a look at. Now, there's one of two ways you could look to actually be on the other side. So let's say you own stocks that are already profitable, okay? And you want to protect the downside and either make money on the downside or you would put in a stop loss, but you like the ideas a little bit longer term, so you're choosing not to get out of those trades. That's when you would need to start hedging. So we're going to talk about two different ways to hedge right now, which are very easy to understand, quite honestly, okay? Very easy. How do you determine share size when you purchase a stock? Share size it's a great question. We don't want to turn this into a coaching call, but it's a great question. But Sal, you need to know the dollar amount you're willing to risk on each trade. That has to be known. Are you risking $100, $500? Are you risking a percentage of your account? Are you risking a percentage of the allocation you're putting there? You need to know the dollar amount first. Then you go and get share size based on that dollar amount and the distance between your entry and your stop loss. That's why I just said 10 minutes ago, it doesn't matter if it's a $10 stock or a $1,000 stock. Once you know the stop loss, once you understand the average true range, which we just talked about, then you get the share size. You have to pick a dollar amount first. Most people, it's 1% of the amount that they're allocating to each idea. And again, even breaking that down a little further, you might have $100,000 in your account. You might decide to have 4 positions that have $25,000 each allocated to that trade. Then from that $25,000, you allocate a percentage of that. So 1% would be $250. So you risk $250, which represents 1% of 1/4 of the money you have allocated to the market. 1%, $250. Then you know you're risking $250. Then you go get the share size based on the stop loss. So if you're risking $1 for whatever the trade happens to be, and you're risking $250, that's 250 shares. That's pretty simple. If you're risking $2 for 250, if you're risking $2 for risking $250, then that gets cut in half. You're doubling the stop loss, which means you have to cut the risk down. So instead of it being 250, it would be 125. So Sal, it's a great question. I'm sure everybody else on the call has similar questions, but you want to know something? If you didn't know that, and you've gotten stopped out of trades that you like because you got scared, it's because you didn't accept the risk before you put the trade on. You just said, I want to be a buyer of this stock and I hope it moves in my favor without ever planning if it moves against you. But I want to go back to the other side. Okay. I want to go back to the other side of the trade because we want to talk about if you already own stocks, how do you consider hedging them on the other side of the market? The first thing you do is you start to look at stocks that are showing relative weakness, groups of stocks that are showing relative weakness. So if we take the financial stocks, for example, that are down 3.5% over the last 5 trading days, we would start to consider looking at stocks like Citigroup or let's say Morgan Stanley. And let's just stick to those as an example. They are already showing relative weakness while the market has been strong. So those stocks have the greater likelihood of going down. So if I own, and again, just using hedging examples, this is all for educational purposes. Everybody use their own share size. If you are looking to protect some of your gains by hedging, by short selling stock. In this case, let's say I have 1,000 shares of FB. I would hedge it with maybe 300 shares of Citigroup or Morgan Stanley. It's not dollar for dollar. We're not going to get into all that today. That's a whole other meeting that we would have inside of our Discord community on a coaching call. But I want to give you the idea. So the first place that we look for ideas to short sell or to hedge would be the sectors and those stocks in the sectors that already have relative weakness. And you can see this group. So real estate, financial, consumer cyclical, industrials, technology. So how would you do that? This is really where it's going to be fun. So now we're going to bring all of this back together. So you probably want to watch this one more time because this is really actionable stuff. Okay. So this screen right here talked about the stocks that were strong and we were looking for a possibility of stocks to be a buyer of. But what if we did the opposite of that? Now we're looking for ideas to short sell. Ideas now would be below the 50-period moving average, and that's 155 stocks. And you might be like, wow, that's too expensive. But what if we also put stocks that are also below the 20-period moving average, and that'll break it down even further. And what if we want to stick to stocks that are only between, let's say, $50 to $100, and that brings it down to 32. So you'll notice all of these stocks already have bearish order flow. BLDR, BLDR is breaking down in a pretty big way right now. And you can see that if we actually drew this out here, this was a pretty big level that BLDR just cracked. And again, if you're doing this kind of stuff every day, this is where it becomes structured. This is where repeatability in your trading income comes from. This is where repeatable, and that everybody wants the same thing out of the market. Control and consistency. That's what we all seek. Okay. You can talk about the pie in the sky, $1 million accounts and all that garbage that those other people talk about. I'm talking about turning 5,000 into 6,000. We're talking about turning 7,500 into 10,000. one trade at a time, 1 week at a time. What we're talking about now here is having control over the process. And then when you have a track record, then you could start to scale because you've proved to yourself that you have a plan. And more importantly, you have the ability to follow the plan. So just walking through it a little bit now, talking about BLDR. Again, we do this every day. We're also looking at Lennar, Pulte Homes, Toll Brothers, Home Depot. So these are all ideas that are already showing relative weakness while the market's strong. So if you're looking to protect your gains, you would look at some of these stocks that already have relative weakness and get a piece on the short side that when they go down, the value of your trade goes higher and you're protecting the downside of some of those other trades. Now, again, it's not dollar for dollar. Please be aware of that. I'm not getting into the nitty gritty. We're talking about super high level concepts here. Obviously, we get into this in a lot more in our private coaching calls, but I want to give you ideas of if you believe it's panic time, if you believe that you don't know what to do when the market's going down, watch this video again. We talked about tape reading. We talked about order flow. We talked about yesterday's video that talked about what we were expecting this week. Yes, you have it in you to say, have the guts. This is what I'm looking for this week. If it happens, great. You get out there and you buy stocks because what you planned for unfolded. If what you planned for did not unfold exactly like you wanted to or expected it to buy stocks, then you have the other scenario and you either stay in cash, you sell your stocks, or you do what we talked about today, which is hedging stocks. So I want to go back to just one more piece here, right here. And so we talked about the scan of stocks to look for potential ideas on the short side of the market to potentially hedge. But then we also talked about these groups of stocks here. Now you'd be like, okay, that's a lot of work. Well, it's really not. Let's say that you want to be industrials. Let's say you want to short industrials is one of the weakest ones. So then you go over to this same exact scan, and let's just use below the 50-period moving average. That brought it back up to 50, right? But then you go over here and you're like, okay, industrials, again, we're taking that from here by doing the sector rotation on a daily basis. Industrials is almost near the bottom. So now you have the same exact scan and you're like, okay, give me industrial stocks. And now you have 5. Now you have 5 that meet that criteria that are on the short side of things that would teach you. Those are the ones now to go look at if you're looking to short sell one of the weakest groups to hedge long positions. If you're an advanced or experienced trader who understands outright short selling, you could either be looking to short sell ideas if they're close to the optimal entry. Remember, that's a big part of it. Or if this is all new to you and you just want to keep it on the simple side, and I know John Bates is here right now, you could look to be a buyer of SQQQ or SDS because these stocks go up when the market goes down. So we covered a bunch of things today, specifically off of what the Fed's going on. The Fed mentioned yesterday, the Fed minutes. The bottom line is I want to help you learn to be in control of the outcome. Nobody can control what happens after we make our decisions, but we have every bit of control about how we look at the market, how we structure our ideas, whether we're buying, selling, short covering, hedging, and which stocks we choose to trade that match that criteria. That control is what you're seeking. That control is what I'm seeking, but it's the consistency that comes from that control that we all really are in the market for. It's not the rocket move to the upside. It's the every week, every month that we want to see our account grow. And all of these steps that we're talking about right now, making decisions, changing those decisions, validating those decisions, understanding initial profit targets. That's our mission here. If you love these YouTube channel videos, please do me a favor. Make sure you hit that subscribe button and smash that like button if you get some value. If you love these videos and you want to share it with your friends, I'd really appreciate that as well. So obviously, we cover these things in a lot more detail in our boot camp. We got a couple of members here. Minvai, thank you so much. Appreciate it. Scott, thank you. And Kent, obviously, appreciate it. Our boot camp is currently closed right now. It's not going to be open for another couple of weeks. But I want to inspire you to think about things differently. Hopefully, these every day, the stock market lives we're doing. By the way, we're doing them now Monday, Wednesday, and Friday. Hopefully I'm inspiring you at the very least. If some of this stuff is new to you, I hope that I'm inspiring you, number one, to think about how much is possible. And number two, to make that possible by having a plan and then having the mindset to follow that plan. You'll be surprised at how many amazing things can happen in your life when you have structure, you have that control, and then the consistency comes from those two things. All right. I have to head out of here, everybody. I have to head over to our gameplay meeting, which starts at 8:30. Have an awesome day, everybody. I'll speak to you soon. And again, if you're new to the channel, do me a favor, click that subscribe button. I'd really appreciate it. Have a great day, everyone. Take care.